Okay, ladies and gentlemen, welcome to the Ownership Channel, where we dive deep into the world of equity compensation and ownership structures at some of the biggest companies in the world. And today, we're going to talk about Netflix. This has been an incredible stock. People who work at the company have made tons of money, but it's actually one of the riskiest equity stock option plan available in all of the markets. And my colleague, Joey Fishman, who is a senior advisor at Ritholtz Wealth Management and an expert, is going to explain why. Joey, good to see you. How are you?
Good to see you. Thank you so much for having me.
Let's start, I suppose, from the beginning. Netflix stock performance since the IPO, which I believe was 2002, back when they were mailing people DVDs. So this has been quite an incredible run. Adjusted for splits, et cetera. Effectively, this is like a $1 stock going to almost 1,000.
Yep.
And then even when you compare it to its peers amongst mega cap tech, this is 10-year annualized returns for Netflix. Walk us through what we're looking at here.
Yep. So this is the 10-year annualized for Netflix compared to its FANG equivalent, or brethren, I should say. So we have Amazon and Apple, Meta and Google, and you'll notice that in each scenario, Netflix trounced them.
30% versus 26 for Amazon, 23 for Apple. Actually, if I asked you which of these companies has the highest 10-year annualized returns, most people would say Apple or maybe Meta. And the answer is actually Netflix, which is pretty extraordinary.
Yep. That huge decline that took place in 2022 really, the recovery had to increase the 10-year annualized return so much to produce a 30% result, which is why it ended up outshining its partners there.
Okay, so now you've got a company that is now the largest entertainment company, publicly traded entertainment, standalone entertainment company, I should say, because the other Magnificent Seven companies do have their own streamers. But Netflix is $381 billion. Let's put this chart up. So from $340 million to $380 billion, that's a lot of shareholder value created. And you point out that for every dollar invested in Netflix at its IPO, you would have $1,270 today. Yep. So you can imagine somebody that bought $10,000 worth, $25,000, $100,000. It just becomes an astronomical rate of return, and in dollar terms as well. Let's take a look at the company's employee metrics. Tell us what's going on here.
Yeah, this is super interesting. Netflix has about 14,000 employees according to its 2024 filing. And what's unique about them is that their revenue per employee is about $2.8 million. Other than Apple, that has about 10 times more employees, no other company on a revenue per employee basis earns as much as Netflix. But I thought that was super interesting. So they're doing a lot with less people.
What's happening with the stock-based compensation chart on the right of the graphic?
That very much reflects the volatility of the underlying stock. Back in 2023, there was a dust up with regard to CEO compensation, that it was too asymmetrical. And so the plan itself had been reconstituted or amended, I should say, in 2024. So you kind of see that big drop off in the number of shares that have been allocated to employee-based compensation. That's part of the reason. The other part, too, is that, this stock is such a wily beast that the volatility alone has the ability to zero out some of the equity compensation that Netflix employees have access to, which we'll talk about in a minute.
Yeah, so let's get right into that. You point out that the Netflix employee stock plan is very unique, and we use the term risky to describe that. But maybe let's start with what's unique about it before we get into the details.
Yep. So Netflix, their baseline salaries for employees are generally set higher than the market. And the reason why they do that is because they give you the option, but not the obligation to invest in the company. And so instead of offering RSUs as part of your total compensation package, they say, listen, you choose how much investment you want to have in this company, and you pull it directly from your salary. So you're using salary deferrals or salary contributions to instead acquire what's called NSOs, or non-qualified stock options.
Okay.
What's so interesting about this, Josh, is that you're paying 40% of the stock's price on the day with which you execute that trade, which is the first of each month. And because you're paying 40% of the stock's value, in effect, for every dollar that you're putting in there, you're getting 2.5 times leverage.
Yeah.
So what ends up happening is
Getting 60%. You're getting 60% of the value of the stock for free because you're buying it at 40%. Okay, got it. That's pretty
So
generous.
So paying 40% premium, essentially, you control the full stock.
Okay.
And so in that scenario, you're effectively controlling, 2.5 times. Your dollar goes 2.5 times further than it otherwise would be. So because the employee has to purchase these stock, they immediately vest. There's no vesting schedule. You don't have to delay or wait. They're immediately yours. What's so interesting about this structure is that it really, really incentivizes employees to focus on long-term success. And what's so interesting about that is that you cannot plan whatsoever about like how a stock's going to perform. Nobody knows how the market's going to interpret it.
Yeah.
So it forces you as the employee to focus on actually doing your job, which is like high quality entertainment that people are going to enjoy and continue to come back for more.
Okay, so it sort of removes the quarter to quarter mentality about if we do this, what will the stock price do? Right, because you've got this long-term incentive built into the way that you're purchasing the shares.
Right, and like with the 40% premium, the stock has to appreciate 67% before you're back to break even.
Now, you also mentioned that there are some risks inherent to doing things this way. And I'm sure people working at the company and people that are longtime employee shareholders, they have lived through many ups and downs. 2022 was one of the most volatile years for Netflix ever. Take us through some of those extra risks.
The saving grace of all this is that the expiration time frame on the NSOs is actually 10 years. So if you were to go out and buy just the traditional option contracts, you'd be hard pressed to find something that's going to expire anything longer than 22 months. In this scenario, they give you a full 10 years. That being said, volatility is a tax on returns. So just like that 40% stat that I just said before, you need a 67% gain to get back to break even. If you're buying stock right now through the company plan at these levels, there's a lot of rallying that needs to take place before you even see $1 or get back to break even. So that in and of itself is a huge risk. There's a higher probability that whatever you invest in this, that you may end up having a goose egg or completely zeroed out. So there's that potential too.
After a 10-year period, if the share price is not higher than where you made these investments, and you're doing that on a monthly basis.
Yep.
Okay. So in a bearish scenario, it's not just that you're down on the stock. You're saying it might have no value.
It might have no value, exactly. And so we do have a chart that shows like over the last 60 months, the distribution of purchases, assuming an employee purchased $2,000 a month of NSOs over the last 60 months. Each of those purchases, what we have here is that the blue bars or the navy bars represent the current value of those shares, while the red line behind is the actual stock price. So it's not surprising that any of the lots that were purchased in 2022 and 2023, like they're worth a fortune because the stock price was absolutely shellacked at that point. All of the most recent purchases you can see are kind of zeroed out because the prices haven't rallied enough to make up for the premium.
Right. So if you're bullish on Netflix, you would say that those recent bars, pay no attention to those because these are brand new purchases. You have to give the stock time to appreciate in value, and that's reasonable. But if you look at some of these historic periods where the stock was trading at a big premium and had gone up a lot, like for example 2021, you did okay in those options, of course, but not as well as you did on the purchases that you made when the stock was down and out during 2022. I think for most people, this is intuitive, that you want to buy low and that your future returns will be higher when you do. And it's also the kind of thing that people, realize they have no control over in real life. So
here's the one bummer. Here's the one bummer about this. Let's say Netflix prices absolutely careen lower. You don't have the ability to call up HR and say, listen, take all my salary. Exactly. Yeah.
Okay. So that's interesting. So whatever the employee stock purchase plan is, It's not variable based on if the stock just fell 30%. You can't push in all the chips for that year. Okay.
That's right. You have to choose annually of what your withdrawals are going to be. Your contributions to the NSOs are going to be.
Now, you point out that executives and directors have an even more unique set of rules. How do things change for the Netflix executive ranks?
Good question. Okay, so these days, the co-CEOs, they have a $3 million salary. A minimum of $3 million has to be held in company stock. And so they have a different structure where they get PSUs, which is performance stock units, RSUs, and NSOs. They're subject to a 3-year vesting schedule, which is different than the employees that immediately vest. But the point of doing this here was to help get the CEOs in the same mentality of that long-term shareholder mentality of you need to be able to hold this for a long time. Prices need to appreciate substantially from your efforts before you're even going to see $1.
And these rules came about in 2023 in the wake of the stock price blow up of 22. I doubt those two things are unconnected with each other.
They were very much connected, yes.
Okay. So how many this applies to all of the executive officers at Netflix?
The two CEOs have their own specific stock plan, and then executive directors. How it was before, and we don't have the most updated information because this was done about a year ago. But if you're an executive officer, the way how it used to work is that you needed to have at least 3 times your annual salary in NSOs or equity or some form of equity within a Netflix.
Big skin in the game.
That's big skin in the game, yeah. And just to give you like an example, like if you go out and buy a house, a lender will let you borrow up to 4 times your annual income, and that's considered insanely risky. So in this scenario here, they're saying you have to have at least 3 times your annual salary in an asset that's going to shake and wiggle substantially more than housing ever would. So there's a lot of agita that comes with that position.
Now, if you're in this position and you choose to use some of your stock as collateral to buy real estate or buy an interest in a sports team or whatever it is, that amount of your shares will not count toward that 3 times your base salary, or for the CEO, 6 times your base salary. Okay.
That's right.
So you really have to not only have skin in the game, but also they're netting out any of that skin in the game that you're putting up as collateral for something else.
That's right. You can't hedge. You can't use that as collateral to hedge against something else.
Okay, I want to get to just this NSO idea, non-qualified stock options, which board members, advisors, and consultants typically are compensated with. Tell us why that's an important part of this story here.
Yeah, so NSOs, the best way to think about them is there's no favorable tax treatment. ISOs are typically given to employees. They're called incentive stock options. And if you can thread the needle appropriately, all of the gains are eligible for long-term capital gains tax treatment. With NSOs, it's different. So you're not going to be you're not going to be taxed on the vest, but you are going to be taxed on exercise, which ISOs don't have, but you are going to be taxed on exercise. And hopefully the shares grow from exercise, and you'll also get taxed again on capital gains. So there's kind of 2 points in time where you are taxed with NSOs. Yeah, incentive stock options, you can coast through and only be taxed on long-term capital gains, but there's a needle that has to be threaded.
Okay, a couple of other things that are relevant to the plan. You know that the employees have a 10-year time frame in which they can exercise. We went over that. The fair market value requirement, how does that work?
It has to be at the full trading price of whatever the current market price is. So they cannot give you discounted shares in order to be in compliance with this plan.
Okay. Employees are subject to specific trading windows. What do we know about those at Netflix?
Yep. So it happens about 4 times a year during earnings season. It's after earnings has been released. Typically is when the window opens up, and that gives employees yeah. No front running. Yeah.
Okay. And E-Trade is the custodian, which the parent is Morgan Stanley.
Yeah, E-Trade has become a power player in custody for equity comp. It's usually them or Schwab, but if it's a heavy option plan, then usually E-Trade controls custody.
Let's get to these charts on buying common stock versus NSOs, just so people could picture the difference.
So we're talking about options here, which is a complicated beast. So let me see if I can unpack this for you. The blue line at the bottom shows your basis to obtain those NSOs, right? And again, the difference between like the publicly traded option contracts versus the NSOs. Publicly traded contracts are 100 shares. NSOs is 1 share, literally. So here, what we're showing you is the blue line is the cost basis to control those shares versus the actual price of the common stock over this time series.
Okay. What's the takeaway for people that own the NSO?
Effectively, what this shows is this is how much you've participated, and this is how much you've spent, $357,000 to accumulate $894,000 worth of value. Now, there's more cost involved with this when it comes time to exercising and paying taxes. So this is the other part of the risk characteristic or spectrum that's not really well understood here, is that in this scenario here, look, if you're a California resident and you're going to sell down these shares, California has a really steep state tax. By the time that you're said and done, like in this scenario, you're probably walking away with about $250,000 to $300,000 net. So it's just not as juicy as like the other plans that we've reviewed in the past, where the spread between the cost basis and the current value is so vast. This is a different scenario because of the inherent cost that the employee has to pay in order to accommodate or to accumulate the shares.
So you are really earning your stock as an employee of Netflix. You're putting in the time and you're taking the risk to really earn that. Let's go into to wrap up some planning considerations here when you're talking with people that are in this situation about what their options are.
The opportunity costs are super high. So if we just take a basic calculation and assume that the S&P 500 is going to return 7.5% going forward for like the next 10 years, because of the volatility that's involved with Netflix needs to return about 18.5% just to achieve that very same return of the S&P 500 at 7.5%. The reason why the S&P 500 has about 18% annualized volatility versus Netflix, which is 50%. So that introduces like a whole series of sequence risk. If you are dumb enough to lean against these shares and use them as underlying collateral, and let's say the margin line is 7.5% and you're withdrawing 10% per year, a margin line typically lets you borrow up to 50% loan to value, and that's being charitable. It would not take long for the volatility of the past few years to initiate a margin call for you. So you would have been smoked under that scenario.
Okay. So on balance, the plan has worked very well for employees. And Netflix has been an incredible company to work for and an incredible stock. So what we're talking about now is the future opportunity for Netflix employees who are participating in the plan. What would you want to leave people with that are faced with this choice?
There are alternatives these days, and so it's not unusual to be weighing the cost benefit analysis between buying the the Netflix stock versus maybe paying down the mortgage at current interest rates. Or maybe it's funding, the 529 or the Mega Roth that the Mega Roth feature is part of Netflix's 401k plan. It's an outstanding opportunity, especially for folks that are in high tax states. That's another alternative to buying the Netflix stocks. There's a ton of complexity and uncertainty when it goes into option contracts to begin with. When you add leverage, it becomes doubly so. So there's a lot of needles that have to be threaded appropriately to make sure that this works for you.
Well, Joey, we're going to let people know where they can reach out to you in the link below. Really appreciate your time and walking us through this very interesting plan. If you are a Netflix employee, potential Netflix employee shareholder, or you've got similar questions about stock options, no matter where you work, Joey is your guy. That's absolutely one of the most important conversations you could have. Thank you so much for your time today. Appreciate it. And guys, thanks for watching. We'll talk to you soon.